everyone. Welcome to Chapter 5, our last chapter in our automated portfolio series. Today's episode will be dedicated on understanding what's been happening over the last week when we entered into a conflict with Iran and how the oil prices and the inability for oil to pass through the passage of Hormuz has affected basically the economy as a whole. So what we see here is that the S&P 500 has been dropping by 2.81%, but our automated portfolio has actually increased by 4.6% over the same 1 month period. And if we look over the last 5 days, we see that our automated portfolio has increased by 2.14%, while the S&P 500 has dropped by 1.61%. Why is that? Well, the reason why that happens is because the automated portfolio basically kicks out any assets that have dropped by more than 3%, and it repurposes that money on assets that have been increasing in value, right? So, but that's not really the full story. I've also been watching the news, and on February 3rd, when I started seeing all of these things dropping, I also went ahead and I purchased USO. And USO is the United States Oil Fund. And because I was watching the news and I was seeing that there was going to be a shortage in oil supply, then I right away figured through just regular common sense that if oil prices, if oil supply is going to drop, then oil prices is going to increase. So they were saying that the passage of Hormuz supplies about 20% of oil to the rest of the world. So my intuition told me, okay, so this is very likely to increase by price, maybe up to 20%. And sure enough, that's what we're seeing here. As we see here, over a week since the conflict started, the oil prices or the price of this asset has increased by nearly 20%. So I bought it at $90.20, and now it is selling for $107.68. So what does that mean? That basically means that when we have a portfolio, we need to be able to reallocate our assets into, or our cash into assets that are going to perform better. And this is going to change based on world events, especially world events that have global implications. So if we continue to look at the portfolio, we see that there are a lot of assets that have exited the portfolio, and this is because they have dropped by more than 3% from their peak. So what does that mean? For anyone who's been following all these chapters, you'll know that when we started with this portfolio, we had $491,000. Then about a week later, it went up to 503, then 506, then 508, and now we are at $513,400. And the reason for that is because the assets that we selected to begin with had very good fundamentals. And so as other assets were dropping in value, general investors, people that you're investing with, saw other assets becoming more valuable, and they went ahead and they gave more money into those assets. And that those purchases that they created because of the demand and basically what happens with the market is the more that you purchase foreign assets at a higher price, the higher that the price can become, right? Basically the willingness to pay for that asset. The end result of that is that the assets that we selected have now increased all the way up to $513,296, while the S&P 500 has actually dropped. So now we also touch base a little bit on a few other things. So for closing, I want to go ahead and just see what happened with those. So if we look at the February 23 drop, if we would have done absolutely nothing, right now we would be at $472,000. Since we start with $491,000, this is a $20,000 loss. So if we would have done nothing and we didn't have trail stops, we would have lost $21,000 by now. And then we also created a safe assets portfolio when everything started on March 2nd. So for anyone who watched chapter 4, they would see that we created these purchases on this date. So as you can see, the total gain for this since we made the purchase has increased dramatically. So the United States Oil Fund has increased by 23%. GSG shares have increased by 10%, and so on and so forth. As you can see here, it has increased by a lot. So over the same 5-day period, let's see what's happened with the S&P 500. So as you can see, this particular uh, portfolio that we call safe assets, it's negatively correlated with the S&P 500. If you notice here, whenever the S&P 500 goes down, this one goes up. And whenever this one is going down, or whenever the S&P 500 goes up, this one goes down, right? Why is that? Well, that's because these are assets that people are going to be putting their money on for as long as the general market doesn't feel safe. Once the general market starts to feel safe to invest again, people will remove money from these assets and put them back into the general market because there will be more money to be made from it. So if we go back to our automated portfolio, what is the lesson learned? The lesson learned is that you should not just leave your money in a portfolio. You need to keep safeguards in order to protect your money. And one of the most important safeguards I have come to use is the trail stop loss, because this allows you to keep your earnings, and it also stops you from having heavy losses. So I just want to say thank you all for watching these 5 chapters. I hope I have been able to teach a little something to anyone who didn't know this already. And I will see you on the next set that we're creating, which is going to be safe assets. And those chapters are going to be dedicated on what are the assets that perform better when we have a lot of volatility and when we have a lot of speculation, which is what we're seeing now.